Hello, everybody. My name is Alesh Eisner, and welcome to the Canadian Money Talk. Today is a special edition. I have my friend Rob from the Mindfull Investor YouTube channel, and we wanted to do a podcast about dividend investing. So, welcome everybody, and let me introduce Rob once again.
Yeah, thanks for inviting me to this podcast, Alesh. Let's get started. If you were to restart, like start everything over again, how would you build your dividend portfolio,
Ooh,
or
good
how would you approach
question.
it?
How would I approach it? This is actually a very valid question because I talk to lots of people who, are starting from scratch or in their 20s, and I'm like, okay, great, good, let's go. Um, I would probably suggest not to have, uh, definitely don't have individual stocks at the beginning and don't have that many of them as I do, because I sort of bought them. It's like, oh, that one looks good, and somebody suggests, oh, sure, okay, and I don't have enough invested in each one to really make it worth it. Uh, and when you have so much, you're pretty much just following the index. So I think if somebody was starting out, I wouldn't even suggest for them to aim for dividends. I would suggest for them to grow their net worth and grow their portfolio, which I think is best done with growth stocks. Uh, Depending on who you talk to, some people say that dividend payers and dividend growers also perform the best. But then there's other studies that seem to say that's not true. But I think I would just start with indexes until I was at whatever critical mass, like we were talking a million, and I would then say, okay, I'm ready to leave my job, and now I want to have passive income. And now you wouldn't want to do it all in one year because you probably had a whole bunch of capital gains at that point. So you might want to spread it out over 3 years or 4 years. But I would start converting those index funds or ETFs into dividend payers. And I mean, the there's a bunch of Canadian ETFs that hold the same banks and the same uh, insurance companies that I hold in individual stocks. It's an ETF that holds it. So just buy one of those. And my advice would be, again, to have three or four and not to have a whole bunch. Uh, so I guess that would be my advice. But I would grow the portfolio first, get to a certain critical mass, say, okay, now I want dividends, and then convert.
That's interesting. I thought you'd be the other way around.
Well, because you have different goals at different stages of your life. At the beginning, uh, you don't need cash flow. You don't need income. If you have a job and you're obviously,
But let's say we're not using the cash flow. We're just dripping. We're building a snowball.
uh, yeah,
So in that sense, it's still going for growth, but it's still going for growth and the dividends together rather than just growth. Like because dividends is somewhat like the safer bet, somewhat less risky than growth stocks.
it is. But if you're just starting out and you do have those 20 years until you want to be financially independent or can reasonably be financially independent. I guess everybody wants to be financially independent right out of school, but you got to put some time in to make the money. uh, you have a goal of growth at that point. uh, what came to mind when you were saying that was stock AC and Accenture. I happen to work for them. I happen to have an employee stock purchase plan, and consulting company, they paid a tiny 2% yield, and I set that sucker on drip, And you know what? Every 6 months, and then later every quarter, I bought another $200-300 worth of a couple of shares basically. So sure, it helped, but I mean the main growth was the growth itself. Certainly, I wouldn't start in my 20s investing in Royal Bank and Manulife because there's just not enough of a kick there, and especially if you have that 20, maybe 40-year time horizon. If at least at the beginning you're excited about your job and you think you're going to work for another 40 years, you can stand the volatility. To your point, you said there'd be a lot of ups and downs. That's fine if you're not needing the money. You're thinking to use the ups and downs for the drip, that you would drip hopefully when.
So you just dollar cost average and get more shares and build a
Yeah,
bigger snowball.
yeah. And then
Huh.
once it reaches that critical mass, then it's like, okay. Or if you're of the frame of mind that it's like, okay, I'll sell a few shares every so often to live off of. If you're going down that direction, you don't have to convert it to dividends at all. But I mean, that's why I mean that's our topic is dividends. So we'll take the dividend path. And I would say, okay, I'm approaching $1 million. I'm reaching that critical mass. Okay, this year I want to convert some to a safe dividend grower. I'm going to buy Royal Bank and Manulife, not to keep choosing those. And next year I'm going to sell the next third of my index and buy buy an ETF or whatever it is. Just do it over multiple years to split up the capital gains a little bit. And when you have that $1 million now in dividend bearers, then maybe you'll have enough money to live on passively.
Interesting mindset.
So which way would you
No,
go
no,
on that one? It sounds like
I'm kind of more, yeah, of what you said, but I would expect you to just build that dividend snowball first because like it's a safer route, but you went for the growth instead, which is interesting.
yeah. If I were starting at 20 years old, right? Because Manulife and Royal Bank don't don't have much of a kick. They're big companies, so they have a good quarter, and when they announce their earnings, they go up 3% when they have a good quarter. You
Yeah.
you get a small company and they have a good quarter and they'll be up 50% in one day. So they have a bad quarter and they'll be down 50%. But if you pick good companies and you take advantage of the downturns, you can get into some serious money pretty quickly. So that's kind of the idea.
So would you say you reverse engineer and say, let's say I want to retire by 35, I want a dividend portfolio of 1 mil, and then we work backwards, and then if I can contribute how much per year, what age do I need to start at? But before then, let's say if I need to start at 35 to 50, that's my building my dividend snowball phase. Then my 25 to 35 is you just go wing it. You just go for the go to the moon. Sort of thing. Because like I find like beginners, if they pick growth stocks, they're gonna pick the most hyped ones. And and no, usually when they pick it is the top.
Yeah, because that's how they know that it's a stock that they want, is because it's quadrupled in the last 6 months.
Yeah,
that's how
that's the
they picked them.
mindset, right?
Well,
Yeah.
that's how they heard about them. Yeah. So going back to the earlier question, if if you are actually running that financial calculator, if you are actually running that Monte Carlo simulation or something like that, uh, you wouldn't really be able to reverse engineer it to say, okay, I want to be here at 35. When should I start? You're starting today. Whatever age you are, that's when you're starting. You can't say, oh, I should have started 3 years ago. Whoops! Like there's no point to knowing that. you're starting today. And as you build up your net worth, you can start making decisions based on that. You can have a goal of 35, but you could hit your critical mass early, or you could hit it at 38. Like it is what it is. You can't do anything about it other than to keep slogging away. Uh, I would sort of treat it maybe, you're familiar with the target date fund. Yeah, so just for our listeners, target date fund is a mutual fund you buy where the person who's running it is assuming you're going to pull all the money out as as of a certain date. So you have a target date fund that is targeting 2030, 2035, 2040. That's when you're going to pull all the money out. And based on how far away that target date is how they determine what is in the target date fund. So if something is 20 years out, it's all stock. If something is 2 years out, then it has a good amount of bonds and safer investments. And if it's due tomorrow, then it's all money market, very safe but low return stuff. So I would sort of treat, to your example, I would treat it the same way. Between 20 and 30, I am in growth stocks. But if I'm targeting 35, I would start converting again over years, just like the target date fund. I would start converting those growth stocks into safer investments. And if you're a hands-on investor, you can do it intelligently. So you can see, okay, this stock has just shot up. Okay, let's sell it, convert that one, and leave the one that had a bit of a downturn. Let's leave that one alone, and we'll do that one next year when it recovers. So, I mean, that would be my approach. So,
Okay. Yeah, no, I think that's like a similar path I went on. I went
okay,
for the growth, I went for the speculative stuff until like the recent 5 years. That's when I took a look at the dividend stocks because I felt it was safer, and that's when I wanted to build this $1 million snowball. Okay.
yeah.
Yeah, interesting.
But you're using the dividend stocks just sort of as a diversification and for the drip. You're
Yeah.
not actually living off of it.
Not
Not,
yet, no.
not really.
No. Maybe down the road. I don't know.
Yeah,
But okay. Because I get this question a lot. Like there are a lot of YouTubers, they just say invest in dividend stocks, nothing else. Like every single one just invest in dividend stocks. Like they don't believe in speculative stuff because like Kevin O'Leary, it's not an asset, it doesn't pay you, so don't invest in it. But I want to be like more of a hybrid. So let's say if you're a beginner, maybe 40% dividend stocks and 60% growth, and then kind of tweak as you go on, because some people are not made to like handle this type of like volatility. They prefer like safer dividend payouts. They want to see that monthly or bi-monthly payout of a couple of dollars, a couple more shares. They want to see things grow that way. But for if they pick a top and then it's like, oh, why does my portfolio keep dropping? Like
yeah. I think that's the risk with growth stocks for sure. If you dollar cost average into them, it's not bad, but you would probably want to dollar cost average into an ETF or a mutual fund, not into an individual stock. Um, or like make a couple of purchases, but you wouldn't set it up for monthly purchases. If you pick the right stock, you're good. If you do it with BlackBerry or God help you Nortel, then that's a different
that goes
different
back to
problem.
the diversification again.
Right, right.
But like I was just talking to this this one of my subscribers actually, and then he was saying like how he wants to grow, but if we diversify so thin, even if that stock doubles or triples, it doesn't matter. Like how like he wants to make the heavier bets, but then he's a beginner, so it's it's
Yeah, that's so here's the thing. Actually, I remember doing a video on it as well fairly recently. So they say diversification is the only free lunch in investing. meaning you can make that decision and you can make it happen, while you can't tell the future about a stock going up. So with diversification, here's the problem. If you have over 20 stocks, the performance, they've done studies, performance is going to be roughly like the index anyway. So save yourself the trouble unless you really enjoy the research, and just buy the index. Diversification is good in that you, to use a sports metaphor, you'll always hit a single. You won't strike out, but you also won't hit a home run. Now, if you are very well researched, educated, and you want to have 5 stocks that you really believe in, then you have a concentrated portfolio. Now with that one, you can hit that home run, because if you pick the right stocks, if 4 of them do really well and the fifth one just sort of goes you'll do really well. But if you happen to pick wrong, and in a couple of months one of them has a bad quarter and drops 10%, then people being risk averse, it's actually diversification sort of works that way for them, because for them, losing is for most people, losing is a bigger pain than the equivalent gain. So it is in happiness or pleasure. So diversification seems to work for people. And yeah, if I had to choose 5 stocks, I mean, that would be some head scratching there. So yeah, that one's a tough one. ETFs are something different, right? If you have an ETF that has energy or financials, or if you want to go geographically, and it's basically following Canadian index, S&P 500, and then emerging markets or something, yeah, you can have 3 of those, but obviously they're diversified internally, so that doesn't really count.
Yeah, so basically a fund of funds. So pick 5 funds, 5 index funds, and just go with that.
Yeah, and let time do the heavy lifting. Like, I know everybody wants the quick wins, but if something can double overnight, it can also go in half overnight as well. So if you don't mind that, and you have the tremendous intestinal fortitude to put in more money after it's dropped, then yeah, then you're a special kind of investor, and you could do quite well. You could still, like, I've had a couple of stocks go to zero, and my gosh, some oil stocks that I've bought, I kept buying on the way down, and they're still down. So if I only stayed with oil stocks, like, I'd goodbye to financial independence. So I'd yeah, I would be curious to see whether dividend payers outperform growth in the long run, like over 50 years, because I've read studies that said that, and then I've read studies that disprove that. Now, I know value and dividend growers have been sort of in a penalty box for the last 10 years, up until the last 6 months or so, where growth has done really well compared to value. Now things have sort of turned around, and the cyclicals are finally back in favor. But I'd really like to know the statistics over a longer period of time, whether growth gets you 10%, and then dividend payers get you 3% in dividends, and then 7% in growth, and it still sort of adds up to the same thing.
Yeah. I thought about this a couple months ago, actually. Like when things switched over, I was wondering if I just built a fund, just bought Berkshire Hathaway and ARC Innovations, half and half, because ARC Innovations over the last year or two, 3 to 5 years, has gone up 5x. But Warren Buffett's thing is still going up like 10%, whatever, every
Yeah.
single year. So you blend those together and you get the best of both worlds.
Yeah, but I mean, the ARK ETFs are very concentrated in technology. I mean, you could have just bought the triple Q NASDAQ and gotten probably something similar. Uh, Kathy got kind of lucky, I think. Uh, Warren Buffett's one of the greatest investors of all time. He's been doing it for a very long time, and he's outperformed everybody. Uh, if you don't mind the volatility of technology, then you can do that. And especially if you're dollar cost averaging and you have constant income, that you don't need to sell any of it. In fact, you're buying more. Then I think that's a good vehicle.
Let's say in that case, someone in their 20s,
Sure.
would you would they go 100% growth, 100% Kathy, or or 50-50 type of thing? 50
Uh,
Warren, 50 Kathy.
well, I think you need to do that KYC to know your client that the financial advisors hand out, right? Or just kind of think within yourself. If you're 20, whether you actually know yourself and know how you're going to react to a 30% drop. I think that's kind of tough. So maybe get an online risk assessment, and ask yourself, when do I need the money? Am I going to be living off of it anytime soon? Can I stand a 10% drop? Can I stand a 20% drop? Can I stand a 30% drop? Like, what is that going to do to me? Uh, Me, I'm not 20, obviously. I know I look like it. I moisturize. But so when the stocks dropped 30% back in March of 2020, I was like, this is the best buying opportunity that I've had in a while. And yet people were panicking and selling. So you kind of have to know how you're going to react to it. And so if you think, okay, I can do 10% versus I can do a 30% drop and still feel really good about myself and know that it's going to go back up, that determines whether you're okay with an S&P 500 or Dow. So maybe 10% would be Dow, 20% comfortable level would be S&P 500, and 30% would be the Nasdaq.
Nasdaq. Yeah,
So
that's a good one. Yeah.
I would sort of look at it that way, but everybody has to look inside themselves and make that determination. But I back to my example where I was at my age, I was happy with a 30% market drop. Uh, uh, you know, you can't just fill out a form and kind of get your risk assessment that way. So you kind of have to, especially if you're do-it-yourselfer, you really need to think about it. When the market's going up, oh, everybody's real brave, right? That they're usually getting in at the top as well, but that's another story. It's when the market's going down, as Buffett said, that's when the tide goes out. That's when you know who's swimming
Without the
naked.
trunks on. Yeah. Oh, that's a good phrase.
So
Yeah.
yeah, so yeah, if I were 20, I wouldn't start out with all dividend payers. I would start out with the more volatile growth because I have a long term horizon.
Yeah, but you're talking diversified.
Yeah, but then as I got older, I would start to, yes, yeah. So I would, I might do the Russell 2000 because small caps over the long run outperform everything, but also take your money on quite a ride. So I might start out with that or with Nasdaq. Um, did you know Lululemon is on Nasdaq?
Nasdaq. Yeah.
That just seems odd to me.
Man, they grew a lot. They like triple in like 2 years.
Fair enough. I just found that out doing some research. I'm like, really?
There's a lot of tech in those pants.
I there's sure.
It's $150 a pair. There's gotta be something in there.
I mean, Tesla, I understand that they're more of a tech company than a car company. I get that. But anyways, that's a total aside. So yeah, and as the year of financial independence neared, I would start transitioning my portfolio just like with those target date funds. I think that's not a bad idea. Again, doing it yourself, like it, the more education you have in investing, the more risk friendly you are as well, and you don't get panicked anymore. But if you depend on your financial advisor entirely, then you should be in safer stuff than somebody who's a do-it-yourselfer. So why don't we call it a day? Uh, I've been Alesh Eisner, and this has been Rob from the Mindful Investor. We are going to do more of these podcasts in the near future, so look for those. And I will wish everybody a profitable day. All right.
Thank you.